Right now, millions of people are looking for their next major financial opportunity in artificial intelligence, crypto, or flipping real estate. But the largest window to build wealth is quietly opening somewhere entirely different. Over the last 40 years, the baby boomer generation has steadily accumulated a massive concentration of assets, heavily outpacing previous generations. This fortune is primarily locked up in highly illiquid forms, specifically family homes, established local businesses, and massive retirement portfolios that have been compounding for decades. While the daily news cycle obsesses over minor stock market dips and tech earnings, this massive foundation of American capital is fully built and is finally preparing to change hands. The catalyst forcing this movement is simple demographics. As the boomer generation reaches and surpasses retirement age, those accumulated assets mathematically have to be passed down to younger generations. This area chart compares the volume of this impending transfer to historical norms. Looking at the current peak dwarfing past transfers, economists project that tens of trillions of dollars will move from one generation to the next over the coming 2 decades. That capital flows directly into the broader economy, altering stock market valuations, shifting local home prices, and redirecting how consumers spend money on a daily basis. A capital movement of this size creates massive macroeconomic distortions across the board. The priority now is figuring out which side of the economic divide you will land on. The most direct beneficiaries are the younger heirs. Many of these individuals will suddenly find themselves holding significant capital in their 30s and 40s, decades earlier in life than their parents did. Right behind them is the traditional financial sector. Investment firms, banks, and wealth managers are already positioning themselves to capture massive revenue simply by managing these newly expanded portfolios. This comparative bar chart shows exactly where that inherited money is likely to go. While older portfolios lean toward traditional assets, younger investors heavily favor the technology sector, funneling new capital directly into AI, cybersecurity, and digital infrastructure. This transfer will also trigger localized real estate distortions. Depending on the area, inherited homes will either flood the market with new supply or be held as family rentals, tightly constraining who can actually buy a house in that specific region. The specific aggressive spending and investing habits of these families dictate which industries thrive and which stagnate over the next decade. But there is a stark other side to this equation. Families who expect zero inheritance make up the vulnerable majority in this specific economic shift. When a massive influx of inherited capital enters the market, it increases demand, driving up costs and asset prices for everyone else, and widening the wealth gap by making everything from groceries to housing more expensive. This economic pressure hits right as these individuals are already facing severe structural headwinds. Rising daily living costs, climbing healthcare expenses, and the weight of student loan debt are already straining household budgets. Without a financial windfall, these individuals face a compounded threat, attempting to pay down their own debt while trying to survive in an economy that has been inflated by their peers' unearned wealth. Yet, receiving a portion of this massive wealth transfer does not mathematically guarantee long-term financial security for the heirs. This descending line graph tracks inherited fortunes. A significant majority depletes entirely by the second generation, and nearly all by the third. When we break down the causes, a clear pattern emerges: poor long-term financial planning, a lack of budget discipline, and emotional panic selling. Cash handed down without underlying financial knowledge is a rapidly depreciating asset. It creates a surprising, often fatal vulnerability for the supposed winners of this transfer. Because of this vulnerability, resilient investors are actively ignoring the noise of the impending wealth transfer and focusing strictly on actionable, defensive strategies. The core mechanics of defensive wealth building don't involve chasing volatile trends. Instead, these investors rely on diversified portfolios and low-cost index funds that capture broad market growth over time. They also practice strict emotional discipline. When market volatility hits, they maintain consistent automated contributions to their retirement accounts rather than trying to time the market. Alongside those investments, they build robust emergency savings. Having 3 to 6 months of expenses in cash acts as a structural firewall, protecting their long-term investments from sudden life shocks. Successfully navigating the economic shifts ahead relies on this kind of systemic consistency, rather than hunting for overnight windfalls. The current economic landscape highlights a sharpening divide in the population, separating those who understand the mechanics of capital from those who do not. Permanent wealth can be built completely from scratch. It requires adopting structural planning, leveraging compounding interest, and having the patience to let assets mature. The challenge is to shift your focus away from the uncontrollable variable of whether you will inherit money. Instead, focus entirely on the controllable variable of whether you are actively preparing for a shifting economy.
As trillions of dollars move between generations, applied financial literacy offers a level of long-term security that a one-time inheritance cannot mathematically guarantee.